Hey everyone, this is Kirk here again at optionalpha.com, where we show you guys how to make smarter trades. Today we're going to go over all of the trades that we made back on September 5th. On Friday, this is Sunday that we're actually recording the video. So big NFL day for you guys who are in the US. I know we have some people outside the US, but super excited for my Broncos to play tonight. So please, root for the Broncos. We had a horrible Super Bowl experience, so we need to get started on the right foot. But I want to get this video done ahead of everything going on tonight in advance of this week coming up. I think it's actually going to be a pretty good week. We're starting to get into the home stretch here of expiration, so the last 2 weeks or so of expiration. I think that we're going to have a lot more volatility come into play. The market's been fairly quiet, but we've seen a lot of big swings just intraday, especially in stocks, where the S&P opens up much higher and then it goes lower, or it opens up much lower and then goes higher. So what that really means is that there's a huge amount of indecision in the market. And once we see some sort of direction, we could break out in either direction. So we could go higher, we could go lower, but we'll just have to wait and see. But I think it's going to be a pretty volatile week heading into expiration. And September, October is usually very volatile to begin with, just as we get towards the end of the year. So I want to go over both of the opening trades that we had on Friday. The first one I want to start with is WFC, which is Wells Fargo. The reason that I added this is because actually a lot of banking has been very strong. We've seen a lot of things break out like Bank of America and Citigroup and JP Morgan and Goldman Sachs. So banking in general has been very strong. And I think Wells Fargo maybe is a little bit lagging as behind some of the other ones. So we're playing it to the upside, not only for that part, but also because we need some more positive delta in our portfolio. We've gotten very bearish on a lot of things, which is okay. It's okay to get bearish or bullish, but we don't want to get too one-sided, right? We don't want to be lopsided and be completely bearish and not have anything available in case the market does continue to move higher. So we're adding a couple of these trades like Wells Fargo, and potentially coming up this week, some calendar spreads above the market to take advantage of a market move higher, right? We want to be semi-non-directional, and it's okay to get directional in a couple areas, but you want to have positions on both sides of the market. So for Wells Fargo, we did a very simple debit spread. We went all the way out to October, give us a lot of time to make money on this trade, and we did a 52.5 debit call spread and paid about $1.50 for each of those. So did it very small. It's only a $300 bet for us. With Wells Fargo, you can see this is the chart. We've had a very rough July and good part of August, kind of the beginning part of August. But actually since then, Wells Fargo's had really strong performance. And on Friday, when we actually entered this trade, it was up pretty nicely on the day. I thought it was going to kind of rally up higher, but really what we're doing is we're playing the breakout here. And with our break even right about where the stock is trading right now, we just need the stock to trade anywhere above this level between now and October expiration, and we have a chance to make money. Now, the reason that we decided to go with a debit spread versus doing something like a credit spread or on Condor is because implied volatility, as you can see in the top left-hand corner of your screen, is at the 14th percentile. So implied volatility rank is actually fairly low. So we want to target those strategies that don't take advantage of a decay in volatility, but actually might take advantage of an increase in volatility across the board. And so debit spreads and ratio spreads and calendars are some of the strategies that you want to start to use to take advantage of possibly move higher in volatility. Now, in this particular trade, we're playing it more directional than just volatility because we have one option. We're long one option and short one option. We're just playing more of a directional trade in the market here with Wells Fargo. And again, adding to our positive deltas in our portfolio to help balance us out. The other trade that we made on Friday, one I'm very excited about, is actually an Apple. So Apple, because of the recent sell-off that it had last week, gave us a great opportunity to sell a very wide strangle in Apple. So I really like this trade. As always with these strangles, make sure that you start your position size very small with these strangles. This is something that we're going to cover actually tomorrow night and Tuesday night on the group coaching webinar talking about trade adjustments. But one of the big things with strangles and any type of undefined risk trade at the beginning is you have to start small with that position, because there is the risk that it goes to that extreme and you have to add more options to the position to help protect it. So you have to basically throw money into the position, throw a little bit more cash at it to actually increase your probability of success by making a better strategy and adjustment. So start small with these strangles. I only did 2 in my portfolio. This very well may be a case, if Apple goes completely against us, that we start scaling this up to 4, 5, 6, 7, or 8, as high as 8 strangles in this thing to help recenter the strategy and take in a massive credit to help protect the position. So again, we're going to be going over that a little bit more in the group webinar coaching that we're doing on Monday and Tuesday, but that's just a little bit of insight into kind of the future strategy in case this goes against us. But right now, Apple's got really, really great implied volatility. We'll take a look at that here in a second. What we did with Apple is went all the way out to October. Again, give ourselves a lot of time. We sold the 110 call on the top side and the 90 put on the bottom side. So we did both of those, the 110 call and the 90 put. We did both of those for a total credit of $140. So took in $140 on this very wide strangle. Now you'll notice that we actually gave ourselves a little bit more room to the top side, given the fact that there's an announcement coming out from Apple on new products. And just generally, Apple's been very strong, except for the news this week about that hack and all those celebrity photos and stuff. So news for Apple has generally been very strong. The stock has been very strong. So I don't want to discount the fact that it could run higher much more quickly than it could run lower. So we've kind of skewed our strangle just a little bit to the top side based on just my personal assumption of where Apple may go as we head into September and October. So if we go to the chart here of Apple on our Thinkorswim platform, you can see that the stock's been beaten down just about 2 days, but had a huge discount. These 2 days basically wiped out the better part of 3 weeks of trading in Apple. So it's very, very quickly how quick the stock can drop if it does. But it's sitting right now about $99. And we did the 90 strike, which is all the way down here, 90. So we did the 90 strike below the market, and the 110, which is really off our screen. We don't even have it on our screen because 105 is up here in the top right-hand corner, if you can see that. And we did another strike that's $5 away from that. So you can see we've gotten a lot of distance between ourselves and the market and gave ourselves just a little bit of extra room on the top side compared to the bottom side. But the reason that we were able to do this strangle so wide is because implied volatility for Apple is now up at the 66th percentile. So it's now definitely above that 50th percentile. We can start being more aggressive with our option selling strategies because this gives us a wider market of options to sell. So option premiums across the board are much, much wider. If we actually go to the trade tab here of Apple, you can see where we actually placed our strangle. So let me just open this up here a little bit. We got to open up all of these strikes to view exactly where we placed our strangle. Let me see if I can capture it on both sides, and I just can't get it on the top side. So on the bottom side, this is our put strangle, our put side at 90, and you can see that the probability of success of just this leg of our strangle is 82%. So it's an extremely high probability of success. Less than 18% chance that Apple goes down and closes below 90 by expiration. So very, very high probability of success on the put side. And likewise on the top side, on the call side, we moved it out just a little bit more, gave ourselves a little bit higher probability of success of Apple getting up to about 110. So the probability of Apple getting up to and closing above 110 is a little less than about 11% or so. So about an 88% chance that it does not get that high. So that means we've got about an 88% chance of success on the top side of our trade. So overall, very, very high probability trade. We're looking at a very good win rate versus loss rate. But again, you got to keep these positions small. Just because we have a very high probability chance of success does not mean that Apple doesn't make that extreme move that nobody's expecting, and we now have to, again, add more positions to their strategy to defend it. Now, some people, if you can't trade strangles, I would obviously suggest you do some sort of butterfly or some sort of iron condor. So you could buy the 110s or sell the 110s and buy the 115s, or you could, down on the bottom side, buy or sell the 90s and buy the 85. So do some sort of an iron condor. That will help cap your margin, and your broker should be able to allow you to do that if you can't do a strangle in your portfolio. So as always, I hope you guys really enjoy these videos. Let me know if you have any comments or questions below. If you're watching this video somewhere else online or on YouTube, you just have to understand that you're actually getting this video about 15 days after it's sent out to just our members. So these alerts and this video that comes out every single night going over all of our trades is only sent out to our members at optionalpha.com. So you got to sign up there, take our free trial, kick the tires, see if this is something that works for you. And as always, happy trading.